Good afternoon, everyone. The time is 1 o'clock. I can see there's still some attendees joining, so I'll take care of a quick introduction and housekeeping from the Kepler side. Importantly, thank you for joining day 2 of Kepler's virtual growth event. I'm delighted to be here with Chris Berrier of Brown Advisory, and obviously the lead PM of Brown Advisory Smaller Companies Trust. Just worth noting that Chris has been at Brown Advisory running this strategy since around about 2006, so pretty well versed in the cycles, shall we say. In terms of content, Chris will talk around process, very importantly, and a very important facet of the trust. He'll talk a bit about portfolio construction and, importantly, the team's approach to mitigating downside risk. He'll also touch upon some nuances of the US smaller companies universe and potentially touch a little bit on outlook as well. Before I hand over, just a little bit of housekeeping from my side. For attendees joining, participant lines will be muted throughout, but feel free to use the Q&A function in the bottom right-hand corner of WebEx. We'll be covering these off at the end of the 30-minute presentation. I think that's it from my side. Hopefully you can all see the presentation live, so I will hand over to Chris to run you through the slides. Thank you all.
Good day, everyone, and thank you for taking a few minutes out of your day to learn a little bit more about Brown Advisory and our U.S. smaller companies PLC strategy. When you think about our firm, one of the benefits is that we are a private investment partnership. We are based in Baltimore, Maryland, in the States. We have a principal office in London, and then we have numerous other offices scattered around the US as well. And I've been fortunate to be at the firm since the tail end of 2005 and watch us grow from a money manager that was 6 or 7 billion in size to something that's at the 120, 130 billion mark today. During that time period, we've been able to amalgamate a number of institutional strategies that are geared to an audience such as yourself. And the longest running of those strategies happens to be the small caps effort at Brown. This was literally the kind of inception point for our firm on the institutional side back in the early 90s when we were embedded within Alex. Brown and Sons, the investment bank. And when our firm became independent, in the late 1990s, there was certainly a point of emphasis to making sure that this particular strategy remained a focal point of the firm. I had an opportunity to join the firm in late 2005 as part of the transition and succession plan for the strategy and started to manage it in its domestic capacity in the second quarter of 2006. So as Hugo mentioned, we have been at this a good amount of time. And all of the process and philosophy items that we mentioned today have largely remained consistent through time up to the present. Have we tweaked things? Sure. Have we tried to improve? Yes. Have we incorporated new data sets, sources of information? Absolutely. We live in a highly competitive world and we have to keep up with it. But the core tenets that we'll talk about today have been in place for quite some time. And hopefully these are items that will continue to stand the test of time and enable us to hopefully generate some solid risk-adjusted returns, not just in the past, but well out into the future. So I want to spend a minute or two because sometimes this area of the market is less treaded over in Europe than it is in the States on some of the particularities around US small cap companies. What does the universe look like? Why is it an interesting place to invest? And I won't belabor these points, but I do think they're critical in establishing a mindset of why you might put a dollar to work in this area of the market. I was attracted to small caps simplistically because I thought they were a little bit more interesting than large caps. I thought you had an opportunity to essentially do a lot of work, come up with an edge, and deploy your thinking into the market in the pursuit of strong risk-adjusted returns. The reason it's an interesting category is it's huge. In the US, there's 2,000 small cap companies bouncing around in the open market every single day. Most of them have been in the equity market as public offerings for quite some time. That gives you a broad catalog of history from which to look upon as you do your analysis. And the other interesting dynamic is that, it is dynamic in and of itself. There are a number of new companies. We just got through a massive IPO cycle that refreshed a lot of the public company content. And while we have a stable of companies that have been around a long time, the ability to increase the content through time or freshen it up is another interesting part about the overall universe. If you compare the US market to other markets around the world, you also find that the governance standards are roughly the same for small cap companies as they are large cap companies. So the hurdle in terms of the reporting requirements are quite high. That means that generally you're getting a better look at the business. You have a better look at understanding what the board's up to, what the incentive structure is, and also what management has accomplished through time. And the final piece is that because of the choice and the number of companies and the fact that the US is a very large home market, a lot of these small cap companies are able to scale to a much bigger size at an earlier stage, perhaps, than some of their European counterparts that start in a functionally somewhat smaller country and then have to expand out in a pan-European fashion. So I think the reason that the US is a very vibrant small cap market is that it has a home country that is large enough in size, in relatively homogeneous, such that when you start a company in Ohio, some of the go-to-market functions and the way you think about your business is the same as California, Maine, wherever. And that allows these businesses to scale. That allows them to be slightly larger in size than perhaps the average European small cap. That's certainly true. And because of that larger average size, the liquidity in the US market is a bit better on an individual name basis and across the universe writ large. And I think that's an attractive piece to mention, because most of the time people will think, well, my drawback with the US small cap company is that they're extremely illiquid. And that is simply not the case. We are far more liquid than the average private company, for sure. And yes, while the Googles, Amazons, Microsofts of the world have more ample liquidity than the typical small cap company, most investors will find that unless you have a huge amount of capital chasing a relatively tiny idea, you are in relatively good stead from a liquidity perspective. So all this choice, leads to an interesting opportunity. And the reason that smaller companies over a long period of time have outperformed their mid and their large cap peers, I think, is principally because people don't spend enough time paying attention to them. There are simply more inefficiencies in the small cap space than there are in other areas of the market. Some of that can be borne out, in the number of analysts covering the company, but sometimes it can be simply borne out in the quality of the coverage that exists. People are spending their waking days focused on Amazon and Apple and Google. They're spending very, very little time on the billion-dollar company that's floating around and has only been public a couple of years. And I think this discovery process, the businesses that go from being unheralded to heralded and appreciated and more widely followed, is what drives the small cap space, again, over substantial periods of time to generate excess returns. What is the price of entry in the small cap space? The price of entry is functionally a little bit more day-to-day volatility. That is well documented, well known. But I think for us, one of the things that guards against some of this volatility, where we can use it to our advantage versus becoming victims of it, is that we are long-term investors. We're thinking about being business owners, not renters of stocks. So for us, what we view as the primary weakness of small caps in the eyes of investors, volatility, is actually one of its greatest active strengths. We have the ability to hopefully, sell high when the market is euphoric, and hopefully buy low when the market is relatively despondent. And that's essentially, if you put this into practice over and over again, you have a category that should perform reasonably well through time. And then if, as an active manager, you can tack on a couple hundred basis points over the long term, that amounts to material alpha and money that you can actually use after a period of a decade or two to make a material difference in your institutional mission or what you want to accomplish as an individual. So if we look at the next slide, and this will be the last one just on the space before we get into the strategy, as I mentioned, the opportunity is really around less coverage. And as you can see, the number of covering analysts for the typical small cap company is about 6. The average large cap is 21. If I'm competing against 5 or 6 sell side analysts and a handful of buy siders looking at a company, I like those odds a lot better than 20 to 30 sell side analysts and hundreds of buy side peers looking at a business. And so I think having a more benign competitive set, similar to the way we think about our companies, the more benign the competitive set, the better it is, the more opportunity there is for an active manager. So it is more possible to outperform, I think, in small than large, but I can attest after doing this for a decade and a half plus that it is certainly not easy, and there has to be a relentless focus on execution if you want to outperform. So let's pop ahead to the strategy and just run through some of the core tenets, and then we can get into maybe some of the return dynamics that have happened in the recent past, and we can touch upon why the small cap market was unreasonably expensive for a period of time and now looks a bit more attractive, to say the least, than it did 12 or 18 months ago. So our underlying investment philosophy is quite simple. When you look at the performance of portfolios, whether those are private equity portfolios, hedge funds, long-only public managers, on down the line, typically what you see is that a handful of great businesses drive returns and drive alpha. And so we anchored our process in trying to find those businesses and let their compounding drive our returns through time. So we are trying to invest early when these are younger public companies, $1 billion, $2 billion in size, and benefit from superior execution and end market opportunities so that the compounded earnings streams drive stocks to appreciate at a higher rate over a long period of time than the vast majority of their peers. If you are looking for businesses that can compound for a long period of time, typically that means that you can't invest in businesses that are below average or subpar on a bunch of different metrics. You have to tilt yourself to looking at the cream that sits on the top, not necessarily diving down into more speculative issues. And so I think this focus on the long term and the focus on businesses that can hopefully become leaders in their respective industries tilts us into a higher quality pool of businesses. And as they mature through time in the portfolio, that has enabled us to actually generate above average returns. But I believe across a whole host of metrics, when we back test it, we've been able to do this at a lower level of risk than the overall market, which I think is quite important when you're assessing a manager's capability. It's not just about the headline number. The critical question to ask is how much risk was taken to achieve that headline number, and they need to be equally balanced in an overall investment process, in our view. So let's dive into the process quickly. I'm not going to get into every nitty-gritty detail in the interest of time. And so here's a process overview. The first piece or bucket is idea generation. We talked about that we have 2,000 companies that we can choose from. Well, idea generation becomes the lifeblood of any good small cap strategy. If you cannot generate a numerous number of ideas on a quarterly basis that you can use to deploy capital in the most effective way you see fit, you're probably not going to last very long. And so this is a critical part of the process. And it is one that we often say is a bit more labor and time intensive than we would like. But we think spending that time and effort is necessary. We do not have a quantitative screen with a list of factors that tells us these are the 5 interesting companies to go buy. The problem with quantitative screens, while useful tools in the investment process, is that they tell you a ton about what's happened in the past. They tell you nothing about what's going to happen in the future. And so for us, all of our efforts are really focused on what is going to happen at the margin with this business? Is it positive change and is it sustainable? Or is there negative change on the horizon? So we have a labor-intensive process where we go out and we interview hundreds and hundreds of management teams within the US small cap space every year. I was up in New York having dinner with one last night. And so this process, while time consuming, is the only way that we believe we can get inside the organization, understand what's going on, and make a judgment about the future, not just the next 12 months, but the next 36 months and beyond. So this is the real starting point for us. Scour the universe, interview hundreds of management teams, and figure out which ones fit our investment philosophy. If we believe that the idea fits what we're looking for, could become a long-term compounder, we then drop it into the due diligence phase. I won't go through all the steps in our due diligence process because many of them are similar to other active fundamental managers out there. You read a lot, you talk to a lot of people, you try to figure out what's going on at the business to the best of your ability to make sure that the PowerPoint slide that the management team is giving you is reflective of the reality on the ground. The thing we spend our time and efforts on the most within our due diligence is to focus on what are the 2 to 3 critical value drivers in the organization. What do we have to get right to make money? And if we get them wrong, how much money are we going to lose? And so we try to establish what are those critical aspects, and then we lean on all of the primary sources of information that we can possibly get our hands on, whether it's leveraging our vast network at Brown Advisory on the private company side, or talking to venture capitalists or private equity players, whether it's leaning on expert networks like GLG and GuidePoint, et cetera. We try to leverage everything at our disposal to make sure that we really understand what's going to move the needle. And then we think about quantitatively, how do we track that stuff? And therefore, we come up with a list of key metrics. We look at them historically, and then we try to model them out prospectively in Excel to figure out what do we think the most likely path is for this business, and what's a bull case and a bear case. And then depending upon the distribution of outcomes and the return potential relative to the risk, we then will move to the phase of let's include it in the portfolio. And that gets into portfolio construction. Our construction is meant to be one that drives high active share. Because when you drive high active share, it doesn't mean you're going to outperform, but it does mean you have a chance. If you are a closet indexer, over the long term, net of fees, you almost have zero chance of outperforming over the long term. And so we've run with low 90s to mid 90s active share for a long period of time. And we achieve that through relative concentration. And we'll hold 70 to 80 names typically within the strategy. But because that might be half of the number of companies that another small cap fund holds, we think about diversification a lot, and not just vis-a-vis the index, although we can use that as some sort of guide as to how the world is architected. We think about it more holistically, valuations, cyclicality, macro trends, things of that nature. And so when we're looking at adding a business to our portfolio, what we're really asking ourselves is this a good investment in and of itself? And does it enhance the overall architecture and structure of the fund or portfolio that we manage? And we keep a long-term orientation in a very, very short-term world. And I think that is a bit of a point of differentiation relative to some of our higher turnover peers that hopefully establishes, once again, a different way of acting in the public markets than most. And hopefully that can continue to drive alpha over the long term. This is the slide that highlights what are we looking for in our businesses. So if there's 2,000 companies, how do we narrow it down? There's a long funnel that we use, and there's a lot of process built behind it. But for the sake of time, let's just review the 3 things we're really looking for. If you're trying to find a long-term compounder that can be a special business, we think it needs 3 elements. No company is perfect, but each has to have some manner of these 3 things in it in order to be wildly successful over a long period of time. The first is growth. Now, we are more growth investors than value investors. And the reason we're more growth investors is not because we believe that buying stocks at any price or follow momentum trends. In fact, it's probably the exact opposite. The reason we lean growth is because if you're going to invest over the long term, you can't walk around picking up cigarette butts. You have to focus on businesses that have enduring qualities that are going to last. And that means they have to be able to grow. You know, they're oftentimes it's said you're either growing or you're dying. And to an extent, that's true. And so we're trying to anchor ourselves and find businesses that have the ability to grow on a durable basis. So we look for large and growing end markets relative to the size of the business. We look at market share leaders or certainly share gainers, and we ask, why is this the case? What is the differentiating aspect of the business, product, service, business model, culture that enables this business to win relative to its peers? So we can establish that there's a big market relative to the revenue base of the business. And we think that the company can essentially gain a larger slice of a growing pie over time. That checks the box number one. The second piece is governance, management. If you have a great opportunity when you're dealing with small cap companies, the people are absolutely critical. You go from 2 founders in a garage to 10 people to 20 people to 30 people. That is a far different proposition than the large cap companies that are 20, 30, 50, 100,000 or more people in the organization. People matter. So what we're trying to focus on is, do we believe that we're putting our money and our shareholders' money with people that we trust, with people that are transparent and candid with us, and people that are driven by a set of incentives that align them well with what we're pursuing, which is long-term shareholder value. And if we believe in that through reading the proxies, interacting with people in the management team, that will check box number 2. The final piece is when you find the ability to grow and you find good people, growth is only one input into an investment. You can't just grow for growth's sake. That growth has to turn into something. And that growth over time needs to turn into cash, and you have to get a good return on your investment. And so when we look at the go-to-market strategies of these businesses, we try to think about, how does the company scale through time? When they bring in the incremental dollar of revenue, how profitable is it? What are their investment opportunities? Are the returns improving or the returns diminishing, whether it's in R&D or sales and marketing? And this enables you to think about the $100 million revenue company today and ask yourself, what's it going to look like at 250 or 500 million in revenue? What are the financial characteristics and what might the market pay for it? And so this piece is really putting it all together. Do they have a scalable go-to-market strategy that we trust? And do we think it is durable through a long period of time? So when we look at individual companies, we have a list of questions we ask from the get-go. And we basically are asking questions against these 3 buckets. And while no company is perfect, if they get over a hurdle in each of these categories, it then becomes a business that we will do more work on. And we think this process and this discipline allows us hopefully to grapple onto more businesses that are going to thrive over time and skip over a handful of businesses or so that might have a more challenging time. So in practice, this is what it looks like. You've got 2,000 companies. Some make the cut, some don't, based upon the 3G characteristics of growth, governance, and go-to-market that I just laid out. We are talking to 400, 500, 600 of them every single year. The companies that pass our screen, they move into due diligence. And what we're really looking for is, do we have an angle of attack? Do we have an edge? Why is this company going to make us excess returns without necessarily excess risk? And then we essentially just rinse and repeat this process over and over and over again. The final thing I'll get into before we just kind of talk about risk management and some of the recent past would be portfolio construction. As I mentioned before, we're relatively concentrated and long-term in the way we think about managing the portfolio. That leads us to high active share. That means we're not hugging a specific benchmark. Yes, we look at the Russell 2000. Yes, we look at the Russell 2000 growth as general proxies for how the economy and market is organized, but we certainly don't treat that as religion, and we certainly don't hug it. So we'll use the the indices in order to understand how we're positioned and what people are going to compare us against. But we are certainly not wedded to them in structure, architecture, or anything down the line. We weigh our positions based upon conviction and opportunity. So what is the long-term potential return relative to the risk over the next 12 months? That's typically how we think. Positions that have a better positive skew are bigger. Positions with a lower positive skew are smaller. Positions that have a poor positive skew are not in the portfolio in our view. We know that we need to be diversified, so we spend an awful lot of time thinking through how we're architected, which I can touch upon on the next slide in a little bit more depth. And as I mentioned before, I think this 3G investment filter that we had for finding compounders points us to higher quality enterprises through time, which means that generally the focus on quality leads to reasonably good downside protection in the strategy versus just opening the kimono to the entire US small cap universe, which has a number, in fact, hundreds of more speculative businesses that we think are better to be avoided than embraced in our overall process. Why sell? We talked a lot about how we go from point A to point B in the portfolio. Why sell? The number one reason to sell is when your investment thesis is violated. Yes, there are times where things get too expensive. Yes, you can swap company A for company B. But at the end of the day, if your investment thesis is violated, if the key metrics drift in the wrong direction, if you believe the 3G profile of the business is compromised, you need to move on. And the reason you need to move on is because once your thesis is violated, you no longer have a roadmap. Essentially, you're flying blind. At least when you have a thesis and you have a few core things that you believe and you're tracking against that, you have a view as to where you're going in the future. Once those break down, you need to leave, because otherwise you're really just surfing the wave of the equity market and leaving most of your success more to chance than some sort of intentional investment where you're monitoring the progress on a quarterly basis. We are certainly far, far from perfect. We make a lot of mistakes. We should buy sooner. We should sell faster and all of those good things and in different magnitude. But I think if you keep a rigorous process discipline and you force yourself to do a little bit better job than the average active manager of getting rid of your losers or getting rid of your highest risk stocks, that is going to pay dividends over a long period of time. This is just the portfolio risk management process. We try to think about everything. We know the one constant in our business is change. We do think about the macro, but we are highly bottom-up oriented. We are monitoring our companies through various operational metrics on a weekly, monthly, and quarterly basis. And we leverage a number of portfolio top-down tools, whether it's our trade diary or using a third party to do behavioral assessments of our trades, to make sure that we have a very clear understanding of what do we tend to do, does it tend to add value, detract value, and how do we improve through time. So this is a multifaceted slide with a lot of different bullet points, each of which are important to the process, and hopefully it simply demonstrates that in the portfolio risk management side of the house, we try to do our best to not only think about how we drive return, but also how we manage risk. The final couple slides here is just about our team. It's the foundation of everything we do. Our firm is a small investment and private partnership. I think that has led to generally lower turnover in our research team than perhaps some of our peers. That has enabled us to keep the team that you see on this page largely together for an extended period of time. And even though there are people that certainly take on different roles at our firm, many of them have been with us for a very, very long period of time. And I think that continuity helps our team improve. As you are likely aware, the team that gets to know each other's strengths and weaknesses is likely able to perform a little bit better than the one that just got together. Final couple things is just, who we are and the underlying positioning today. This is the Russell 2000 index and the Russell 2000 growth index according to ICB sector definitions. When you think about our portfolio, we lean a little bit more to the growth side, where our weightings in healthcare and technology are a little bit higher. Our content is fewer typically in more cyclical areas of the market and places like financials, where the Russell 2000 is littered with small cap banks, albeit most banks don't exactly excite us. So it's an area that we're quite selective in. So I would think about us straddling the line in the middle here of this slide. You know, we are lean more growth because there are types of businesses in healthcare and tech that I think more often than not meet our criteria. And some of the things in the Russell 2, or certainly in the value, tend not to have the composition that we seek out in our investments. And thus we're a little bit light in those categories. And thus, because we're looking at long-term compounders and because we're seeking out certain attributes, we lean a little bit more growth than we do core. Here's a quick snapshot. One of the things that I think is important to remember is that whether you use ICB or GICS to look at how we're represented, they tend to be somewhat inaccurate in their composition. I can tell you today that when I look at FactSet every day in the morning, you know, we're probably around 16 to 17, maybe 18% tops in information technology. The rest of that can be distributed out into energy, financials, communication services, consumer discretionary within this pie chart that you see. And so we try to keep it very balanced. And one of the reasons we try to make note of this is that at the end of the day, if someone is just doing a casual appraisal of the portfolio, you may see some differences in composition vis-a-vis ICB GICS and how we speak to the overall strategy. So what has allowed the strategy to do reasonably well over the long term and you know, particularly well, I think, in the short run, has been that we were in a period of time, and I'll take more on this in Q&A, where small cap stocks, because of very easy money policies at the Fed, became exceptionally expensive. It was clear that valuations were unsustainable, and to a great degree, we tried to pull back, and we tried to allocate capital away from the areas of greatest excess into anything else that we thought had a reasonable risk reward. We weren't perfect in this execution, in this transition from sort of a bull market to a less than great market, but we did a little bit more than our peers, and that has allowed us to do reasonably well in the short run compared to the Russell 2 and the Russell 2000 growth in particular. And when you pull back the envelope, I'll flip ahead here, you can see that over the long term, you know, the performance of the strategy has been reasonably good for a long period of time. And I would say that that is largely due to the fact that we have a good team that's well dedicated, works hard. We have been at this in a similar fashion over 16 plus years at this point. And so we know what our philosophy is. We understand what the process is. We try to correct it where it fell a little bit short in the past. And we're trying to pull together every single tool at our disposal to hopefully continue to make sure that the performance that we've been able to generate in the past is hopefully going to be improved upon in the future. But investing is a difficult game. It keeps us on our toes every day, and we know we need to execute if we want to be able to outperform. So with that, you know, we're trying to drive returns through bottom-up stock selection. We're trying to mitigate downside risk through our portfolio construction. We lean a little bit more growth than we are core. So in times when the market is down and growth leads to the downside, if we can hang in there with the R2, that's a pretty good result in our view. And that's basically what's happened on a year-to-date basis. As growth asset prices have come down tremendously, we believe that the climate is becoming more interesting for us to deploy capital in an effective way over the next 1, 2, and 3 years. And so while we are experiencing short-term pain in the US equity market, particularly on the growth side, I think out of this pain comes opportunity. And we are both optimistic around the potential for improved, you know, relative results, and also the potential for, you know, much better absolute results in the space, and hopefully with the strategy in the quarters to come. So with that, I'll stop and turn it over to Hugo for any questions.
Brilliant, Chris. That was an excellent top-down run-through of the strategy. So a couple of questions that spring to mind that we've had from investors that worth asking off the back of your summary. Number one, you've obviously talked about valuations coming down and opportunity set looking a little bit more exciting. Just wondering if you could give a bit of color on if there's any sort of particular themes that are coming out or any sectors that are particularly interesting you at the moment, or subsectors, companies, specifics, anything around that?
Yeah, sure. I think when you looked at what happened at the US equity market, particularly small cap growth stocks, the period that we were in of very let's call it ultra low rates and a period of very, very robust capital formation led to a lot of investment in technology and healthcare businesses that had potentially great promise over the long term, but were very, very early in their life cycle. And so 18 to 24 months ago, as we were experiencing an IPO boom, a SPAC boom that it was almost unimaginable in scope and scale, a lot of money went into tech and a lot of money went into healthcare. And the valuations, as money poured in, went up and up and up. So for a period of time there, you had huge excesses built into technology and healthcare, and valuations that were as high as almost any other period in history, including 1999 and 2000. So we were in pretty rarefied air. That's not saying that other things weren't expensive as well. Most of the small cap growth area of the market for a period of time did lean expensive. But what's happened as the Fed has been forced to change its policy priorities given the inflation dynamics we face today, is that the areas of greatest excess have felt the greatest pain. And so tech is down the most, pockets of healthcare have gotten crushed, and other areas have done not so well, but they've held up. Thematically, if you look at the opportunities today, we are probably most excited about a chance in the coming quarter or two to buy a handful of tech companies that we have watched for a period of years, but haven't owned because we thought they were too expensive. However, we still think you need to be selective today because the fundamentals within software are slowing. And while valuations have come down, they're certainly not at their troughs on a historical basis. So while we have become more excited to deploy capital and have leaned in opportunistically against certain investment opportunities, I wouldn't say we've characterized it as a opportunity to just put all your chips in almost irrespective of what's going on in the sector from a company by company point of view. And in fact, while we've gotten more interested in what's going on in the market, we see more opportunities and we've been deploying more capital across the small cap tape. Thematically, nothing stands out. We have been pretty balanced in our capital deployment. And that is because this is a difficult environment. The number of cross currents that are going on in the global economy and geopolitically are probably too many to count. And so as we are coming off a period of excessively easy monetary policy and we're slamming on the brakes, as we went from being in lockdown with COVID to now basically fully opening up again, these are giant economic things that have caused, great amounts of irregularities in the most recent financial results, and are probably going to lead to some bizarre comparisons and things to happen in the not too distant future. And so I think because we're trying to be prudent and we don't have a crystal ball, what we're looking for is just good, solid companies across the market. Don't put too many eggs in one particular basket. We don't know how the world is going to unfold. We don't have a perfect forecast. And so we're just looking at the best bottom-up opportunities we have. That being said, thematically, I think that tech is going to be the most interesting one for us to get incrementally more aggressive over the next couple quarters. particularly in software if the current environment remains challenging.
Brilliant, Chris. That's a very comprehensive answer, and perhaps speaks to why process is so important, particularly at the moment. And I guess on that point, you talked a lot around process and its importance to you and the team. I'm just wondering whether you've got any specific stock examples that are perhaps emblematic of your process.
Sure. I think we over time have owned a variety of different types of companies that have been better performers for us. A lot of them stand out as being highly innovative, somewhat faster growing, call it 20% plus businesses, and those tend to catch the market's eye in the short run because they're just doing things that are new or growing at a rate that catches everyone's attention. But I think what you have to do is realize that it's sometimes boring can be beautiful. And one of the businesses, in fact, the longest running company we've had in this portfolio is Waste Connections, which is now a borderline larger cap waste management company. We bought this company back very close to the financial crisis when it was a pure small cap. And we were attracted to the fact that the company was maniacally focused on culture, maniacally focused on safety, and really had a strategy that they had proven out of focusing on US and now Canadian markets that are not the large urban centers in the US, but I would say the secondary and tertiary cities and municipalities around the country. And what that did is it gave them an opportunity, as they used tuck-in M&A in different locations, to build near monopolistic businesses in local markets. And with those monopolistic positions, they were able to put in contract methodology that enabled them to index to inflation. And so what the company has done is run the same playbook over and over again for many, many years and turn effectively trash into cash on a consistent basis. And so while we have now sold more shares of waste than we probably own, at least on a percentage basis, it is still in the portfolio because it represented an opportunity in stressed times for us to own something that we know will be extremely predictable in nature and will hopefully allow us to hold and preserve value and maybe grow it a little bit during a difficult market. And then what we are likely to do is, given its size and scope today, similar to other periods where waste is vastly outperformed, we're likely to trim it down through time and deploy the capital into things that perhaps have an opportunity to compound at a higher rate through time and are now trading at multiples that are much, much lower than they were 12 to 18 months ago. And the reason I use waste is, one, it's the longest tenured company in the portfolio. They did the very simple things exceptionally well. And while, yes, there are a number of software businesses that we own today that I think could be quite interesting, or semiconductors or high-tech healthcare companies, the reason it's important to highlight something like a Waste Connections is that it shows that our time and attention is not just dedicated on one swath of the market. It's focused across the market, and we're looking at a lot of different businesses. And what we would like is our top 10 and the portfolio at large to be highly diversified and eclectic in nature, so that once again, all our eggs are not in one particular basket. So waste is emblematic, but there's many, many more examples I could give you in high tech or healthcare that would also be very, very fitting with our process.
Brilliant, Chris. That's incredibly helpful and a very salient example, I think. One final question, I think, if you don't mind. I'm very cognizant of time. We've got about a minute left, so I'll try and make it a fairly cogent question. You've talked a lot about management teams and how important they are in the small cap universe. Just wondering if you could talk a little bit more about whether there's any kind of key, consistent characteristics you see within management teams within the companies that make their way into the portfolio.
Yeah, I think if you start at the board level, what you want to see at a board of directors is a diverse array of backgrounds and expertise that are relevant to where the company is in its current life cycle. And so if you can find people that sit on a board that have been at larger companies that know the difficult points to scale through time and what you have to do and pitfalls to avoid, that's essential. If you have a great technologist or a great security officer on your board that can help provide guidance on, where do we go when we live in a period of, heightened cybersecurity risks, that's important. And I think the board in and of itself is setting the incentive system and the agenda to make sure that the company is not being run for the short term to maximize short-term compensation, but is being run in a prudent way to balance investment opportunities and drive long-term value. So we start at the board and we think through that without, any level of perfection. Let's say, we're looking at the outside going in and doing the best we can, but obviously, we're not sitting in the board meetings. So we try to talk to people that know the people on the board or talk to board members themselves to get a feel for the company. And then when you go to the management team, your skin in the game is always good. So someone that owns a significant amount of equity, I try to tell people that rightly or wrongly, my largest investment outside of, my equity position in Brown Advisory is my investment in this strategy. And so for better, for worse, I am woefully undiversified in nature, but it means at least I'm eating my own cooking. And so I'm thinking like it's my money, which at the margin through time, I think is a good thing. And so having a management team that owns a little bit of stock, or perhaps it's a founder who's very passionate about the business, is a good thing. And then you have to make sure that you have complementary skill sets and personalities. You can't have a bunch of people that are all great salesmen. You can't have a bunch of people that all want to be CEO. You have to have people that like what they do and have particular competencies that are complementary. And so if you can find that where you have the dynamic sales CEO that's going out there is talking about the mission of the business and the culture, well, you probably want to juxtapose that with a CFO that's a little bit more of a bookworm, that's very focused on the numbers and is trying to make sure that the narrative reflects the reality of the numbers and on down the line. And so we spend, a lot of our time trying to understand who the people are, what have they done in the past, and do we think their prior accomplishments are relevant to the particular business they sit in now? And if we get relatively good feelings about the architecture of the board and the management team and the culture that they build, I think importantly for us, we've been back on the road. So in the last week or so, I've gone to visit multiple different companies. And the value of being able to walk around a headquarters is that you can feel what the organization is all about. And you can ask yourself, would you want to work here? Are people likely to stay and all that good stuff? And, that culture element is what comes out of the decisions made by the board and the management team. And if you think about whether it's Harvard or McKinsey, tons of studies have been done. And while, market product is great, market positioning, all of this good stuff matters, number one, number two, or three in a successful business is always culture. And so if the board and the management team can get that right and can make people feel good about the company, where they work, its mission and how it conducts business, that is a key element in trying to find long-term compounders. And that's why it's such an important part of the overall investment process.
Brilliant, Chris. Another very comprehensive answer, and thank you very much. And I think with that, we'll call this session a day. And again, thank you very much, Chris, for your time and the colour you've given on how you're clearly navigating through a pretty challenging market environment at the moment. Thank you all to all the participants for joining. Thank you for your time, and again, a final thank you to Chris for taking the time this morning. A recording will be available afterwards, along with the slide deck, I believe. And there are a couple of questions that I haven't answered that I'll take offline. And I think with that, I'll wish everyone a good day. Sorry, apologies.
Thank you. Appreciate it.
Thank you, Chris. Thank you.